Good day, ladies and gentlemen, and a very big welcome to my YouTube channel. As you can see by the title on the screen, we are doing a summary of capital allowances. Now, let's get straight into it. At the end of this lesson, you should be able to distinguish between the different types of assets and the capital allowances that are applicable to each. And you should be able to calculate the capital allowances in respect of movable and immovable assets. Before we get into it, if you are a UNISA CTA Level 1 or Level 2 student, I've got some exciting news for you. I will be hosting a webinar this coming Saturday in preparation for Test 4. If you'd like to learn more about companies and closed corporations, dividends tax and contributed tax capital, acquisition and disposal of shares, foreign income and trusts, please join us this coming Saturday on the 3rd of August from 8:30 in the morning to 11 a.m. for only 250 rands, guys. This webinar is open to students from all institutions. If you feel like you want to learn more about these topics, you're more than welcome to join us. For more information, please go to the description box where you'll find more information on how to join. See you then. Now let's take a look at movable assets. I've just summarized three of the key important sections that I think you need to know. So the section 11E, that's supposed to be a small letter E, not a capital letter E. We've got section 11E that deals with wear and tear allowance. We've got section 12C that deals with manufacturing assets. And we've got section 12E that mainly deals with small business corporations. Right. So let's start with section 11E for wear and tear. The binding general ruling outlines two methods of calculating wear and tear allowance. That is the straight line method, which entails equal installments over the asset's expected life, and the diminishing value method based on the asset's remaining life. So the concept of wear and tear, guys, is just like depreciation. If you know depreciation, then you shouldn't struggle with calculating wear and tear. The binding general ruling also states that small items, that is, assets that cost less than 7,000 rand, can be fully written off. So if you've got an asset which is less than 7,000 rand, there's no need to divide it by the useful life. You just claim the full amount as long as it's less than 7,000 rand. Now, for those who don't know what the binding general ruling is, so I have downloaded the document from the SARS website, and I just want to show you guys what it looks like. So as you can see, it's written binding general ruling, issue number issue number 4. So this specifically deals with wear and tear allowance. So this is the binding general ruling, you guys. It's basically a document and the respective useful lives, right? So as you can see, we've got air conditioners for different types of air conditioners. For window type, it's 6 years. For mobile, it's 5 years. For room unit, it's 10 years. So that's the useful life. We've got, it says here, computers, for computers, personal computers, the useful life is 3 years. For drilling equipment, as you can see, the useful life is 5 years. So when the question tells you that the useful life of an asset is 3 years or 5 years or whatever, that information will be coming from this document called the binding general ruling, right? So it's important to note that wear and tear is the only capital allowance which we are going to apportion. Otherwise, none of the other capital allowances covered in this lesson are apportioned, okay? Secondly, we've got section 12C, which deals with manufacturing assets. Guys, as soon as you see the words process of manufacturing in a question, that's how you know that you are going to apply section 12C, right? So section 12C is mainly applicable to assets that are used or machinery that is used in the process of manufacturing. Now, if the asset is new and unused, we will claim 40% in year 1, 20% in year 2, 20% in year 3, and another 20% in year 4. So the total must be 100, right? If the machine is a second-hand machine, we are going to claim 20% over a period of 5 years. Very important to note where, sorry, this section 12C is not apportioned. Like I said, wear and tear is the only one which we will be apportioning, right? Um, Thirdly, we have Section 12, Cap E, which deals with small business corporations. If you don't know what a small business corporation is, please go look it up in your textbook or in the legislation under Section 12, Cap E. So this is how we're going to be claiming capital allowances in respect of small business corporations. So for manufacturing assets, we're going to claim 100% in year one, right? So the full amount will be claimed in the first year if it's a manufacturing machine. For non-manufacturing assets under a small business corporation, we will claim 50% in year one, 30% in year two, and a 20% in year three. And again, we do not apportion this capital allowance, right? So just a few things to take note of. Basically, all movable assets qualify for, I'd like to believe that all movable assets qualify for Section 12E, right? For example, motor vehicles, computers, and etc. They all they all qualify for Section 12E, right? However, you may find a situation where, for example, this asset qualifies for 11E, but it also qualifies for 12C, or it also qualifies for 12E, right? So in that case, you have to make the best decision for the taxpayer, and the best decision for the taxpayer would be choosing the capital allowance, which would result in the highest deduction from the normal tax calculation or from the taxable income calculation, right? Um, for example, let's just say you are dealing with a company which is a small business corporation, right? And you know that for small business corporations, if the machine is used, if it's a manufacturing asset, you're going to claim 100%. It doesn't make sense for you to apply Section 11E, because Section 11E would give you a right of period where you claim the capital allowance over a period of years, whereas you can claim 100% because this is a machine which is used by a small business corporation and it's a manufacturing asset, right? So that's just one thing to take note of. An asset can qualify for both wear and tear in Section 12C, or for both wear and tear and Section 12E, and you always need to make the best, elect the best capital allowance for your taxpayer, right? Another thing I want you guys to be aware of is sometimes VAT would be included in the cost. And where the VAT is included in the cost of an asset, you always have to take it out. So you remove the VAT component and you calculate the capital allowance on the cost excluding VAT. Right. So let's have a look at the immovable assets in terms of Section 13. For the purpose of this session, I have only summarized about 4 of them because this is a summary. I can't cover everything. So let's start with Section 13, which deals with buildings and improvements. Okay. So Section 13.1 Section 13.1 allows a taxpayer to deduct an annual allowance. So I'm going to be highlighting important keywords. So Section 13 allows the taxpayer to deduct an annual allowance on the cost of the building that was erected by the taxpayer or purchased by the taxpayer from another taxpayer or another person who was entitled to the annual allowance, or purchased by the taxpayer from another person where the building was never used before and is wholly or mainly used by the taxpayer or tenant or subtenant if the building was let during the year of assessment for trade purposes other than mining or farming, for a process of manufacture, research, and development. So Section 13.1, guys, basically relates to buildings such as factories, manufacturing buildings, and etc. So this is for factories, manufacturing buildings, and etc. Right? So as soon as you see a factory or a manufacturing building, then you know you are dealing with Section 13, subsection 1. The general rule is we are going to claim an allowance of 5% per annum. We do not apportion this capital allowance, right? Remember I said for the purpose of this lesson, the only apportionable allowance is wear and tear. The rest of them are not apportioned. Secondly, I've got a summary of Section 13(6), which deals with residential units. Section 13(6) allows taxpayers to claim an allowance on residential units as defined. So you need to go look up the definition of residential units and improvements to these residential units. If the residential unit or improvement to it were acquired or the erection commenced on or after 21 March 2008. The section is applicable if a taxpayer owns new and unused residential units. That unit or improvements are exclusively used by him for the purposes of trade carried on by him and is situated in South Africa, and the taxpayer owns at least 5 units in South Africa. So the keywords there, it has to be new and unused. It has to be used for the purpose of trade, and there must be at least 5 of them for us to call them residential units. The general rule is that we are going to claim 5% per annum, and an additional 5% of the cost if it is a low-cost residential unit. Please look up the definition of low-cost residential unit in the Income Tax Act. And the last important thing that you need to know about this section is there is no apportionment. Right. The third section that I want us to take a look at is Section 13 Queen, which deals with commercial buildings. Section 13 Queen allows a taxpayer to claim an allowance on commercial buildings. For example, an office building, a warehouse, a shopping mall, or a retail store, and the improvements to these buildings. Okay. This allowance is applicable to any building or improvements that were contracted for and the construction, erection, or installation commenced on or after 1 April 2007. Section 13 Queen is applicable if the taxpayer owns a new and unused building, right? Now, I have seen something that a lot of lecturers like to do. So they don't necessarily tell you that the building is new or unused, but what they tell you is it is purchased from a developer. So that's how I know that it has never been used. It has just been developed. So no one has occupied it as yet. So that's, a keyword that they like using to indicate that the building is new and unused. Section 13 Queen is also applicable if that building or the improvements are wholly and mainly used by the taxpayer during the year of assessment for producing income. So if it's a block of offices, it has to be generating some form of income. If it's a warehouse, it has to be generating some form of income. The cost of a building or improvement for Section 13 Queen is the lesser of the actual cost incurred by the taxpayer or the direct costs under a cash transaction concluded at arm's length. So the principle of arm's length still applies in all of these transactions, actually, not only Section 13 Queen. If you don't know what arm's length means, please go and look up the definition of arm's length, because this is going to be very important when you are dealing with transactions between connected persons. So that's your homework. Go look up the definition of connected persons. Go look up the definition of arm's length. Okay, so the direct costs under a cash transaction concluded at arm's length on the date on which the transaction for the acquisition, erection, or improvement was concluded. So that is the market value. So in simple terms, we are going to claim this capital allowance on the lower of the cost and the market value. But also, like I said, depending on what is the arm's length value, and also depending on whether there's a connected persons relationship. So please go look up the definition of connected persons. Go look up the definition of arm's length, because that's going to affect the capital allowances that you can claim. The general rule is we are going to claim an allowance of 5% per year on the cost of the building unless a part of a building was acquired on or after 21 October 2008 without the taxpayer erecting or constructing it. So let's just say we've got a double-story building, and a taxpayer only purchases the first floor, or only a room in the second floor. So that's an example of part of a building. So if you are dealing with part of a building, we are going to claim 55% of the acquisition price if a part was purchased. Um, and also on the improvements. So we're going to claim 30% on the improvements if part of a building was acquired. So just to do a quick recap of Section 13 Queen, general rule is we claim 5% per year unless part of a building was acquired. If we're dealing with part of a building, we're going to claim 55% of the acquisition price and 30% on the improvements. Again, there is no apportionment on Section 13 Queen. The last section that I want us to have a look at is Section 13 Sept, which deals with low-cost residential units. So please go and look up the definition of low-cost residential unit because there is a definition which gives you a very detailed guideline in terms of what qualifies to be called low cost. So we look at the rental value that this building will be bringing in, I think, as well as the value of the property itself. So those are the, I think, two components that we look at that determine whether a building is a low cost residential unit or not. But please go look it up, guys. So this deduction seeks to provide relief to employers for the provision of an interest-free loan to the employee and is applicable to any disposal on or after 21 October 2008. So what employers do is they grant interest-free loans to their employees to purchase low-cost residential units. So that's another thing, though. There's an interest-free loan there included in that transaction, and there's a transaction between employer and employee where the employer is giving the employee a low-cost residential unit, but is also extending an interest-free loan so that the employee can be able to pay for this unit. So just take note of that. This section will only allow a deduction for a disposal. They make reference to disposal there because, like I said, there's a transaction between employer and employee. So this section will only allow for a deduction for a disposal if the disposal is not subject to any condition, except for the condition that the employer is required to on termination of employment, or in the case of consistent failure for a period of 3 months to pay the amount in respect of the low-cost residential unit, dispose the unit to the employer for an amount equal to the actual cost. So basically, this section will only allow a deduction if there are no other conditions, surrounding this transaction. No conditions surrounding this transaction besides the general conditions that if the employer stops working for this employee, if the employer and employee relationship is terminated, or if the employee fails to pay, then the employee has to dispose this unit back to the employer for an amount equal to the actual cost, excluding finance costs to the employee of the unit. Yeah, okay. So dispose of the unit to the employer. Yes. To the actual dispose of the unit. Sorry, guys. Dispose of the unit to the employer for an amount equal to the actual cost, excluding finance or borrowing costs to the employee of the unit and the land on which it is built. The disposal is financed by interest-free loan to the employee. So that's, like I said, another key indicator that you are potentially dealing with a low-cost residential unit. There is an interest-free loan which would have been extended to the employee to buy this property. And the selling price is equals to or less than the actual cost, excluding finance or borrowing costs incurred by the employer of the unit and the land for the employer. So basically, the selling price must be equal to what the employer would have spent on this property. So those are some of the key indicators that you are dealing with a potential low-cost residential unit in terms of Section 13 Sept. Now, the general rule is we are going to claim an allowance of 10% on the outstanding loan at year end. So this is very important, guys. This 10% is not on the value of the property or on the value of the low-cost residential unit, but it is on the value of the loan, the outstanding balance of the loan that the employee would be owing the employer. So that's the general rule. And lastly, again, there is no apportionment on Section 13 Sept. Thank you guys so much for watching. We have come to the end of our lesson. Please do not forget to comment, subscribe, and like, and share with your friends. And please watch my ads because YouTube is not paying me to do this content and I need a little bit of motivation. But otherwise, thank you so much to my returning subscribers. And if you are returning for the second or the third time and you haven't subscribed, please hit the subscription button. Thank you guys so much. Goodbye.